May 15, 2023. Something happened that should have been a front-page story everywhere: New York, London, Tokyo, Beijing. But most Americans barely noticed. Saudi Arabia signaled it was willing to accept China's currency, the yuan, for some oil transactions, oil that, for nearly half a century, had been priced and settled almost exclusively in US dollars. That might sound like a small accounting detail. A technical tweak. A footnote for traders. It's not. Because oil isn't just a commodity. Oil is the bloodstream of the modern world. It powers factories, ships, planes, fertilizer, plastics, basically the entire physical economy. And since 1974, the rules of that bloodstream have been simple: if you want the world's most strategic resource, you pay in dollars. That single rule helped create what people call the petrodollar system, a quiet, invisible machine that kept global demand for US dollars permanently high. Not because America's economy was always perfect, but because the world needed dollars to function. Now imagine what happens when that rule starts to crack. Not tomorrow. Not overnight. But the moment the biggest oil exporter on Earth opens the door, just a little, to a non-dollar settlement, it sends a signal to every central bank, every finance ministry, every commodity trader on the planet, there are other options. And when alternatives reach critical mass, history shows the network effect can flip. Suddenly, the dominant system, no matter how powerful it looks, starts losing gravity. This is the part most people don't understand: reserve currencies don't last forever. Not the Portuguese real. Not the Dutch guilder. Not the British pound. Every global reserve currency in history followed a cycle: rise, peak, overreach, cracks, then replacement. The scary part is not that the dollar disappears. It won't. The scary part is what happens when the dollar stops being required. Because that requirement is what gave the United States an economic superpower. The ability to borrow cheaper than anyone else, to print money with consequences spread across the globe, and to sustain a lifestyle that, for decades, ran ahead of what the real economy alone could support. So here's the question that matters. If the petrodollar era is ending, if the dollar is entering the most dangerous phase of the reserve currency cycle, who benefits, who gets crushed? And how fast can this move once the tipping point is reached? Let's walk through the pattern that has ended every reserve currency before, and see where the dollar sits right now. Here's the big claim: simple, uncomfortable, and historically consistent. Reserve currencies die. Not because a country wakes up one morning and chooses to end them. Not because the money literally disappears. But because the world quietly stops treating that currency as the default, the safest, and the most necessary tool for global trade and savings. And this isn't a one-off event. It's a cycle. Over the last 500 years, the world has run this same script multiple times. A dominant power rises with real economic and military strength. Its currency becomes trusted, liquid, and widely used. Then, over decades, that power stretches itself too far: wars, debt, financial excess, political overreach. At first, nothing looks different, because the system has momentum. Everyone still uses the old currency, because everyone else still uses it. But behind the scenes, competitors appear. Alternatives are built. Trust starts to fracture. And once the world has a workable backup plan, the decline accelerates. That's why reserve currency cycles tend to last roughly 80 to 110 years from the moment dominance is established to the moment the world clearly pivots. Sometimes longer, sometimes shorter, but the rhythm is there: rise, peak, overreach, cracks, transition. Portugal had its era. The Netherlands had its era. Britain had its era. Each one felt permanent while it was happening. Each one believed it was the exception. Each one had reasons why it couldn't end. And each one ended anyway. So when people say, the US dollar can't lose reserve status, America is too big, too powerful, too central, they're repeating the exact mindset every previous empire had at its peak. Now, let's be precise: this isn't a prediction that the dollar vanishes. The dollar can remain important for a long time. The real question is whether it remains dominant, the currency the world must hold, must use, and must route its trade through. Because dominance is what creates the privileges. And here's where the tension comes in. If you map the historical pattern onto today, the signs are starting to line up in a way that's hard to ignore: growing alternatives, rising geopolitical fragmentation, and a world that has watched the dollar get used as a weapon, and is now building escape routes. That's why some analysts argue the U.S. dollar may be approaching the danger zone of the cycle, the phase where the replacement system isn't stronger yet, but it's strong enough to make the old system vulnerable. And once a reserve currency becomes vulnerable, the decline doesn't feel like a smooth trend line. It feels like stability, until it suddenly doesn't. Before we go any further, we need to define one thing, because once you understand it, the whole story snaps into focus. A reserve currency is the money the world treats like its financial oxygen. Central banks hold it as their main foreign exchange reserves. Companies use it to price global trade. Governments borrow in it. When crisis hits, people run toward it, not away from it. And when a currency becomes the world's reserve, it doesn't just become popular. It becomes structurally necessary. That creates four privileges so powerful they almost look like cheating. Privilege number 1, structural demand. If the world needs your currency to buy oil, settle trade, and park reserves, then other countries have to keep buying and holding it, constantly. That demand isn't based on how good your economy looks this quarter. It's built into the plumbing of global commerce. Privilege number 2, seigniorage, the ability to print claims on real stuff. This is the part that sounds insane until you see it clearly. A reserve currency issuer can create money at relatively low cost and exchange it for real goods and services produced elsewhere: cars, electronics, energy, raw materials. In plain terms, you print paper, you receive the world's output. No empire gets that privilege for free. But reserve currency empires get it indirectly. Privilege number 3, cheap borrowing. Because global institutions want safe dollar assets, they buy U.S. Treasury bonds. That demand helps keep interest rates lower than they otherwise would be. It means the U.S. government can run larger deficits, for longer, at cheaper rates, because the world finances it. Privilege number 4, exporting inflation. When a normal country prints too much money, inflation stays mostly inside its borders. But when the reserve currency country expands its money supply, the inflationary pressure spreads outward, because the world is holding that currency and those assets. Your inflation becomes everyone's problem, diluted across the globe. Put those four together and you get something massive. An economy that can consume more than it produces for long periods, and a government that can borrow on a scale that would crush most countries. And that's the emotional core of this entire story. This is the quiet engine behind America's lifestyle. For decades, the U.S. didn't just compete in the global economy. It helped set the currency rules of the global economy. The dollar's reserve status acted like hidden scaffolding beneath the American standard of living, making imports cheaper, borrowing easier, and financial crises easier to absorb. But here's the catch: the same privileges that make the reserve currency era feel stable, also make the decline brutal. Because when the world stops needing your currency, those privileges don't fade gently. They reverse. To see where this movie goes, you have to watch the earlier versions. Same plot. Different costumes. Scene 1, Portugal, the Spice Empire. In the 1500s, spices weren't seasoning. They were strategic assets: medicine, preservation, status, wealth. Pepper, cinnamon, cloves, worth more than gold by weight in European markets. Portugal didn't just trade spices. It controlled the routes, armed ships, fortified ports, choke points from Africa to India to Southeast Asia. Rise asterisk if you wanted access to that world, you needed Portugal's networks, and often its money. Overreach asterisk but Portugal was small. A limited population trying to hold a global chain of outposts with constant military costs. Debt piled up. Rivals studied the system and built their own fleets. Crack asterisk once competitors had alternate routes and stronger financing, Portugal's monopoly lost gravity. The currency didn't explode overnight, it just stopped being the obvious choice as power shifted away. Scene 2, the Dutch, the financial machine. Now the camera cuts to the 1600s, and the center of gravity moves to Amsterdam. The Netherlands perfected something even stronger than cannons, modern finance. Rise *, the Dutch East India Company, VOC, wasn't just a company. It was a global operating system for trade, backed by capital markets. Amsterdam built institutions that felt revolutionary: early stock trading, reliable banking, deep liquidity. Merchants trusted Dutch money because the Dutch system was efficient, transparent for its time, and, most importantly, liquid. Overreach *, then came war. Repeated conflicts with England and France. Military spending surged. The Dutch economy was built for trade and finance, not massive land wars. Meanwhile, London started copying Amsterdam's playbook, building its own financial infrastructure and absorbing global commerce. Crack * blockades and geopolitical pressure hit the Dutch where it hurt: trade flows. Confidence shifted. Capital followed convenience and security. Amsterdam didn't become poor, but it stopped being the uncontested core. Once the network effect moved, the decline accelerated. Scene 3, Britain, the pound and the gold promise. By the 1800s, the stage belongs to London. Britain's navy controlled the oceans. Its factories dominated industrial production. Its empire spanned the map. Rise, the pound became global money because Britain anchored trade, and because the gold standard gave the world something it craved. A simple promise. Pounds could be converted into gold at a fixed rate. In a chaotic world, that felt like solid ground. Overreach *, but empires are expensive. Britain fought costly wars, expanded commitments, and financed it all with debt. Then the 20th century hit like a wrecking ball: World War I, then World War II. Britain borrowed heavily, especially from the rising power across the Atlantic. Crack * after the wars, the empire weakened, the economy was strained, and the gold promise couldn't hold. Confidence broke. The pound didn't disappear, but it fell from global ruler to regional currency, while the dollar stepped into the role Britain could no longer afford. Different centuries. Different technology. Same sequence. A power wins trade. Its currency becomes the default. It stretches too far. Rivals build alternatives. And then, when trust and networks shift, the crown moves. So here's the map. 8 stages. Not a prophecy. A pattern. The same rhythm that took down every reserve currency before. If you can hold this model in your head, you'll always know what matters, and what doesn't. Stage 1, dominance is established. A country becomes the center of gravity because it is genuinely strong. Trade runs through it. Security depends on it. The world trusts it. Its money becomes the default. Stage 2, the peak. The system looks unbeatable. The currency is everywhere. The country expands its commitments. Military reach grows. Debt grows. It can afford it because the world keeps demanding its money. The privileges hide the cracks. Stage 3, alternatives are built. Quietly at first. Not to overthrow the system overnight, but to reduce dependence. Competitors create parallel routes, new trade networks, new banks, new settlement systems, new sources of credit. Stage 4, the currency is weaponized. Sanctions. Asset freezes. Financial exclusions. The dominant power uses the system as leverage. It works in the short run. But it teaches everyone the same lesson: if you rely on this system, you can be cut off. Stage 5, trust starts to fracture. Diversification begins. Central banks reduce exposure. Trade starts experimenting with new pricing and new settlement. The reserve share falls slowly at first, then more steadily. The old system still dominates, but the direction is set. Stage 6, the danger zone. This is the turning point. Alternatives grow large enough that using them becomes easier. Cheaper. Safer. More convenient. Network effects begin to flip. People switch not because they hate the old system, but because everyone else is switching too. Once that happens, decline stops being gradual and starts becoming fast. Stage 7, Crisis Acceleration. One shock can trigger it. A war. A debt panic. A banking event. A policy mistake. Suddenly, the fear becomes contagious. Countries sell reserves. Investors dump assets. The currency drops sharply. The dominant power tries to stabilize it, but it's fighting momentum and psychology at the same time. Stage 8, Replacement. A new standard emerges, but it never happens in a single day. It's a multi-year transition. Sometimes it's a clear successor. Sometimes it's a multi-currency world. Sometimes it's a neutral anchor like gold. The old currency survives, but it no longer runs the world. That's the model. 8 stages. A simple truth sits underneath all of them: reserve status is not a trophy you win forever. It's a contract the world renews every day. Renewed by trust. Renewed by utility. Renewed by networks. And that's why the most important question isn't whether the dollar is strong this month. The question is which stage we're in. Because if you're in stages 1 through 4, the system can still look solid. If you're in stage 5, the cracks are visible but manageable. If you're in stage 6, the rules start changing under your feet. And once you hit stage 7, you don't get to slow it down with speeches. You don't get to vote it away. You're dealing with the physics of a network collapse. Now we're going to take this map and lay it on top of the modern dollar era. The milestones. The fractures. The signals. And we're going to see whether the world is still renewing the contract. Or quietly preparing to end it. If you lay that 8-stage map on top of the modern dollar era, the timeline starts to look less like random headlines and more like a sequence. Around 2000, the dollar is at or near its post-Cold War peak. The U.S. is the center of gravity. The internet boom turns into American financial dominance. Wall Street is the global switchboard. Most trade is priced in dollars. Most reserves are held in dollars. If the world needs safety, it runs into dollars. Stage 2 Energy. Peak confidence. Peak inertia. Then 2008 hits. The global financial crisis doesn't overthrow the dollar. It does something subtler. It plants doubt. The world watches the U.S. financial system crack, then get stabilized with emergency liquidity, bailouts, and a new era of money creation. Again, the dollar survives. It even gets stronger during panic, because in a crisis people still reach for the deepest market on earth. But trust is no longer a free resource. This is the moment the story shifts from unquestioned to watched carefully. The cracks don't break the system. They make other countries start building exits. 2014 is where weaponization becomes a turning point. After Crimea, sanctions expand and financial access becomes a tool of statecraft. A message lands globally: your reserves, your payments, your cross-border finance can be turned into a pressure point. That's when the blowback logic starts to activate. Not because everyone suddenly loves alternatives, but because dependence now has a visible cost. So parallel rails begin to matter. China accelerates work on its own cross-border settlement infrastructure. Building systems designed to move money without relying entirely on Western pipes. Russia builds its own messaging network as a fallback. More countries sign currency swap lines. More trade deals experiment with local settlement. These aren't replacements yet. They're backups. Stage 3 moving into Stage 4. Then 2022 detonates that lesson in front of the whole planet. When Russia's central bank reserves are frozen and access to key payment channels is restricted, every government that isn't fully inside the U.S. led alliance hears the same signal at maximum volume: reserve assets can become conditional. Not conditional on economics, but on politics. At that point, the shift stops being theoretical. It becomes operational planning. Weaponization creates blowback. Countries start asking a practical question: if this can happen to a major power, what stops it from happening to a mid-sized power next time? The answer is simple. Nothing. So the incentive to diversify stops being optional. It becomes risk management. And that takes us to 2023, the headline that began this video. When reports surfaced that Saudi Arabia was open to settling some oil trade with China in Yuan, the meaning wasn't, the dollar is finished. The meaning was that the most symbolic pillar of the petrodollar era no longer looked unbreakable. Oil is the world's price signal. If even a fraction of oil trade can route around the dollar, you're watching stage 5 evolve towards stage 6. Alternatives becoming normal enough that more players start copying the behavior. By 2024 and into 2025, the pattern tightens. BRICS talk grows louder. Bilateral trade deals multiply. Local currency settlement expands in pockets. Central banks keep adding diversification tools, including gold and non-dollar assets. Payment networks outside the traditional rails keep improving, not necessarily to replace the dollar tomorrow, but to ensure the world has options the next time politics hits finance. This is what it looks like when the system is still dominant, but no longer uncontested. Not collapse. Preparation. And preparation is how every reserve currency transition begins right before the danger zone. In past centuries, reserve currencies didn't fall like a trapdoor. They faded over decades. The world moved slowly because everything moved slowly. Ships moved slowly. Gold moved slowly. Information moved slowly. Finance moved slowly. This time is different in one important way: speed is built into the system. Reason 1, technology compresses time. Capital doesn't need weeks to cross oceans. It moves in seconds. If confidence breaks, the reaction isn't a slow rotation out of assets. It can become a stampede. A central bank can shift reserves with a few clicks. A fund can dump exposure in minutes. That changes the physics of the cycle. It makes stage 6 and stage 7 sharper. Reason 2, the alternatives already exist. When Britain weakened, there was basically one realistic successor, the US dollar. Today the world has options. The euro. The yuan. Regional currency blocks. Gold. Even new settlement frameworks that don't require a single winner. That means countries don't have to wait for a perfect replacement. They can diversify immediately, imperfectly, and still reduce dollar dependence. Reason 3, the petrodollar is political, not natural. Portugal, the Dutch, and Britain were backed by real economic dominance in trade and production. The petrodollar era, by contrast, leaned heavily on a geopolitical arrangement that reinforced dollar-only oil settlement. Political arrangements can change faster than economic structures. When relationships shift, incentives shift. And when incentives shift, pricing conventions can shift surprisingly quickly. Reason 4, the U.S. debt load raises the stakes. A reserve currency issuer can carry more debt than most countries because global demand finances it. But if that demand weakens, the adjustment becomes painful and fast. Higher interest costs. More refinancing pressure. Harder political choices. In previous transitions, declining empires often had room to tighten belts gradually. A heavily indebted system has less room to glide. It has to react. Reason 5, globalization makes contagion instant. In earlier eras, a currency crisis could stay regional. Today the dollar sits at the center of global debt, global trade invoicing, and global liquidity. If confidence shifts, the shock doesn't stay inside U.S. borders. It radiates through banks, commodities, shipping, emerging market debt, and cross-border funding markets everywhere. The tighter the network, the faster panic can travel. Put those 5 together and you get tipping point dynamics. Most of the time, the dominant system looks stable because inertia is powerful. People stick with what everyone else uses. But as alternatives scale up, the cost of switching drops. Then a strange thing happens: the system doesn't decline in a straight line. It holds, and then it slips. Slowly at first, then suddenly. That's what makes this phase so dangerous. The transition can feel impossible right until the moment it becomes inevitable. If the dollar's dominance fades, the world doesn't get one clean outcome. It gets a portfolio of outcomes. Some winners. Some losers. And a lot of messy in between. Start with the likely winners. Gold tends to do well in transitions. Not because it's magical, but because it's outside the system. When trust in paper claims weakens, a neutral asset with no issuer becomes more attractive. That doesn't guarantee a straight-line rally, but historically gold becomes a beneficiary of uncertainty in monetary regimes. Commodities exporters can gain leverage too. If oil, gas, metals, and food can be priced and settled in multiple currencies, sellers have more negotiating power. They can diversify receipts, reduce reliance on one currency, and potentially demand better terms. Even partial de-dollarization can shift bargaining power toward the producers. Low debt, high-credibility safe havens may attract capital. Countries with strong institutions, stable currencies, and manageable debt loads can become destinations for money looking for safety outside the dollar. Their currencies can strengthen, and their borrowing costs can stay relatively low. And some BRICS members could benefit, especially if they succeed in building reliable trade and settlement channels that work at scale. More autonomy. More flexibility. Less exposure to sanctions risk. Again, not guaranteed. But it's a plausible upside. Now the likely losers. Dollar savers and bondholders face purchasing power risk. If the dollar weakens over time, holding cash, long-duration treasuries, or dollar deposits can mean your wealth buys less on the global stage. Even if nominal numbers look fine, real value can erode. Countries with heavy dollar-denominated debt are vulnerable in both directions. In the short run, crises often make the dollar spike, raising debt burdens. In the long run, if the system shifts and global liquidity changes, refinancing becomes harder and more expensive. Either way, dependence becomes a weakness. And parts of U.S. financial dominance could be pressured. If more trade settles through non-dollar rails, some activity that once flowed through New York can migrate to other hubs. That doesn't mean Wall Street disappears. But marginal business, fees, influence, and the default status of U.S. markets can slowly chip away. The key is this: reserve currency transitions don't distribute pain evenly. They move wealth, pricing power, and leverage. Not in a single dramatic day, but through years of incentives quietly rearranging the world. So what's the timeline? No one can stamp an exact year on a regime change like this, because transitions don't happen on a calendar. They happen when incentives and confidence cross a threshold. The best way to think about it is in if-then scenarios. If the world keeps building parallel rails, if more commodity trade settles outside the dollar in small but steady increments, and if reserve diversification continues, then the next 10 to 15 years could look like a slow slide that suddenly feels faster. Not because the dollar vanishes, but because its share of the system falls below the level where dominance is self-reinforcing. If a major shock hits first, the timeline compresses. A debt market scare. A banking event. A geopolitical escalation that forces bigger sanctions and bigger blowback. In that scenario, Stage 6 can snap into Stage 7 quickly, because the world won't need decades to move money the way it used to. It can reprice risk in weeks. If the U.S. manages to restore confidence and reduce the need for others to build exits, the transition stretches. The dollar stays central longer. The decline remains gradual. The world becomes more multipolar without a single dramatic break. That's a real possibility too. But here's the warning that history keeps repeating: the dominant power rarely recognizes the turning point while it's happening. Because the system still works, until it doesn't. Because the currency still feels safe, until the alternatives feel safer. Because the network effect stays loyal, until the network effect flips. That's why this story matters. It isn't about cheering for collapse. It's about seeing the cycle clearly before the headlines force everyone to see it. Portugal didn't believe it could lose the spice routes. The Dutch didn't believe Amsterdam could be replaced. Britain didn't believe the pound could fall from global ruler to regional money. And yet, it happened. History doesn't repeat line by line, but but it rhymes in the incentives, the overreach, the cracks, and the shift in trust. If you want to understand the next decade before it becomes obvious, subscribe to this channel. Because we're going to track the real signals, reserve shifts, trade settlement changes, BRICS moves, alternative payment rails, debt stress. And the moments when Stage 6 starts looking like Stage 7. The petrodollar era is fading. The dollar's dominance is being tested. And the next chapter of the global order is already being written, quietly, in plain sight. If you made it this far, you're not here for noise. You're here for patterns. So here's the deal, subscribe to Global Lens, because this isn't a one-time story. It's a moving timeline. And we're going to keep tracking the signals that most people miss until it's too late. Hit the like button if this video helped you see the bigger picture. It tells the algorithm to show this to more people who actually care about understanding the world, not just reacting to it. And comment one thing below: which scenario do you think we're heading toward, a single new dominant currency, a multi-currency world? Or a return to some form of commodity-backed settlement? I read the comments, and your ideas shape what we cover next. If you want to go deeper, check the next video on your screen. Global Lens breaks down geopolitics, money, and power with clear logic and real history, so you can see what's coming, not just what already happened. Subscribe, turn on notifications, and I'll see you in the next episode on Global Lens.